Tonight in Business with economics editor Tshepo Mongoai, we look at business partners. This is a fund for SMMEs which has financed companies for over 3 decades in South Africa. But while it provides loan financing, there seems to be a tricky development, which we'll hear all about now with Tshepo. Good evening to you and welcome. If you look at their website, you look at the proud proclamations of how they don't only provide funding, but they walk the entrepreneurial or the business journey with those that they finance. Why is all not as it seems, Tshepo?
Well, Business Partners Limited it's got a long history in providing finance to SMEs in the country, as you correctly pointed out, since early 80s, 1981. And it was established with the shareholding of government. Certainly SIFA is one of the second biggest shareholder in it. You've got major banks who are also shareholders in the entities, and they pride themselves as providing finance to those businesses that usually commercial banks would not fund because of many other reasons, including risk and so forth.
So they literally are the loan of last resort or last option for a lot of these SMEs.
Absolutely. They do have a little bit more risk appetite in terms of the business that they would fund. There are various criteria that they put in place to ensure that they actually minimize their losses in those businesses. These are some of the business that are really struggling. They need funding to expand or to deal with some of the challenges that they may be confronting as entities.
So what's gone wrong?
One of the issues is that, of course, some of those businesses that have actually accessed loan from the likes of Business Partners Limited, they've been raising concerns, especially with the issue of royalty agreement that are part of these loans. And the major concern is that, of course, maybe for those businesses who actually pay their loans through and finish, there is another layer in terms of this. It's not an interest, but is another kind of a loan that called royalties that you need to service as well. It takes different forms. In some instances, they could actually insist that they are taking equity in the company, or maybe there's a profit sharing in the entity. But that's another cost that the business has to deal with. And in the past, many businesses since early 2004, they've been going to court to challenge this clause. And unfortunately, I mean, if you have committed and you've looked at the clause and you've agreed to it, it's very difficult. One of the issues is the interest, high interest rate that the royalty fee comes in. I mean, we know royalties, it goes with franchise. But this is not a franchise, but it's arranged as if it's a franchise because you have to pay this as part of your loan agreement, and it's linked to it.
Well, I mean, I want to ask how Business Partners is now explaining this, but are you saying that, you know, it is hidden in the fine print, in the T's and C's, or is it openly presented to those who are seeking funding? So they are in fact aware that this is happening, but they disagree. Which is it?
Well, the issue is it's not hidden because if you're signing, obviously, I mean, I already indicated these are businesses that are in distress, they're under pressure, they've got challenges, they desperately need cash. One of the arguments that Business Partners has advanced in the past, but certainly we have not been able to talk to them, we've been trying, is that because of the risk element that they are willing to take, that's why they came up with this royalty clause. So business do look at it, they agree to the clause, so there's no excuse. But one of the reasons is also because some, maybe out of desperation or excitement, they overlook it. And they realize when they have to pay it and they're taken to court because they thought, well, we've serviced our loan, we are done with all the interest. And then the company says, wait a minute, you have not financed your royalty agreements, so you need to commit to that. And then they go to court.
So it's not charged concurrently with the interest? Is it a lump sum that comes at the end of the loan term?
It's structured in different ways. It could be a profit sharing on certain percentage over a certain period. It could also be a revenue that you're going to share in the future. It could also be a stake that they're going to take in the company and so that they can get their money back.
Tshepo, you know, as we're speaking, and we've seen cases like this before, especially when they go to court, if it is there in black and white, not hidden, not obfuscated, then the legal issue seems set. What you're raising and potentially what the others are raising who've actually gone to court and try to get this sorted out is an ethical and a moral issue, given, as you say, they are the lender of last resort. Businesses have nowhere else to go. So should there be a different approach with how this is tackled, given that everyone signed with their eyes wide open?
Well,
just playing devil's advocate, I'm still on the side of the underdog and the small business. I'm just joking.
I think you've raised the question of morality. You have SIFA, which is a state-owned entity, is the second biggest shareholder after Remgro. And you would have thought that perhaps they could influence certain decisions, and so that they're able to change this model so that it's more accommodative, because it's actually hard on business. And in order for business to survive, it's actually very, very difficult, because it actually triples the cost of borrowing for those businesses, and it makes it very difficult for some of these businesses before they actually turn the corner.
Yeah.
And remember, one of the conditions is surety. You must demonstrate that there is surety in the entity, so that should you fail to pay your loan, there is some kind of asset that they can actually attach. In addition to having that royalty and your usual loans agreement that's in place.